right. So good afternoon, everyone, and welcome to Mondays at Murdoch. Thanks for joining us for yet another very interesting session. And thanks, Giles, for joining us. This is your second time at Mondays at Murdoch. There was a very interesting topic you delivered in December, which was a guide beginner's guide for trading, which is very much appreciated by not just students, but a lot of our faculty and corporate partners as well. And yeah, based on the success of that session, we decided to ask him to come in again and tell us a little more details about pricing patterns and changes and in currency trading. So thank you, Giles, once again. He A very quick introduction. He's the chief currency analyst at HYCM. He is often featured on top tier financial media, including City AM, Yahoo Finance, Morningstar, Business Insider, Forbes Middle East, Kuwait Times, Qatar Tribune, Sina Finance, Money Observer, MoneyWise Magazine, Global Ranking, and many more. He's a gifted communicator. He conducts a lot of seminars, webinars, trading workshops worldwide. He also conducts a free FX Week Ahead webinar on Mondays and also Level Up Practical Workshop on Wednesdays, which talks about details on online trading decisions in a variety of live market conditions. Giles also likes to travel the globe and lead an intensive Forex trading course to help aspiring traders and take their trading skills to the next level. So, thanks again and welcome, Giles. And we really hope this session is going to be amazing, like the previous one for sure. Just a few housekeeping rules. Some of the participants wanted to know if their microphone was not working. So basically, for these webinars, we don't have the microphones and video enabled for the participants. But if you have a query or a question, please feel free to type them on the chat box or the Q&A box below. And I'm sure, Giles, you'll be happy to answer them at any point or towards the end. So welcome again. And yeah, it's over to you.
Well, thank you very much. I hope you can hear me okay, and I hope you can see my screen okay. It should say trading seasonal patterns. So is that all coming over clearly? Excellent. First of all, let me say it's absolutely lovely to be back here again at Murdoch University. I very much enjoyed my first session, and I really did enjoy the excellent questions that I was asked. So please feel free to ask questions as we go along, and I'll either answer them as we're going along, or I'll spend some time at the end dealing with them. So don't be shy. I always say the only wrong question or the only silly question is the question that you didn't ask. So please feel very at liberty to ask me any questions as we go along. This topic, which I wanted to share with you, is actually a very fascinating topic. And it's something that does warrant considerable study. And it's something that many experienced traders use in their trading. But actually drilling down what these seasonal patterns are specifically and what's causing them can be a tremendous advantage to not only the professional investor and trader, but also the casual investor and trader. And so I really hope to show you what these seasonal patterns are. Now, by way of introduction, we all know that there are patterns in the seasons. It's obvious, isn't it? We have, particularly here in the UK, you have a summer, a spring, an autumn, and a winter. And the weather itself drives certain patterns. So, for example, here in the United Kingdom, when it's cold, we use more heating. We'll use more electricity and we'll use more gas. So on a very, very simple level, we know that the patterns in the weather is going to affect demand for different commodities and different financial products. Now, when you look at those seasonal patterns and you see that not only are there patterns in the weather, but there's patterns in harvests, there's patterns with taxation policies, there's patterns with mutual fund inflows you suddenly see that seasonal patterns can be a very powerful force. And what I'm going to share with you through this webinar is how to trade seasonal patterns, the actual phenomena, what drives them, what they are, some really good examples for you to take away for the rest of your lives. And on top of that, I'm going to show you how I use them in my personal trading, managing my own personal fund. And I'll show you how a professional trader goes about using these in the specific way. So without further ado, let me just introduce you what a seasonal pattern is. I'm going to give you a definition to help you understand. So a seasonal pattern, let's just go to the next slide. Let's check this works. A seasonal pattern is a trading opportunity with above average profit that recurs nearly every year. Okay, so that is it's a trading opportunity with above average profit that reoccurs nearly every year. And the way I understand them as a professional trader is they're a technical signal with a fundamental background. So I'm looking for a reason for the seasonal trade. That's what I want to see. I want to see a reason. It could be something as simple as the end of a harvest, the beginning of a harvest period. It could be due to taxation reasons. But I want a fundamental reason why these seasonal patterns are in place, because that tells me that it's not just a statistical anomaly, it's not just a statistical thing of interest, but it's actually a statistical fact that's tied to a real world event. So that's how I'm using them. I'm using them as technical signals with fundamental backgrounds. Now, these seasonal patterns, it's incredibly diverse how often they occur. They occur in all sorts of different markets. It's not just the commodity markets with crops, but it's things like the indices. You see it occurring in stocks, currencies, commodities, and bonds. So you think all those different instruments that are used, this could be a standalone strategy in terms of seeking superior returns in and of itself, given the range of different markets that seasonal trades occur in. It's something I'm often referring to in my blog, HYCM, and advising HYCM clients about opportunities that may be ahead. I'm often looking at seasonal patterns and tying them to real world events so that people have opportunity to potentially have superior returns. Now, they occur as well over many different time periods: yearly, monthly, weekly. There can be repeating events, and they can even be intraday. So you can even get patterns within the trading day. And that makes sense, because if someone was to look at a seasonal pattern of your life, you'd find that there's certain things that you do each day in a very consistent and predictable manner. You've only got to think: eating, sleeping, turning electrical appliances on, turning electrical appliances off. For financial markets, are very similar in that they have specific drivers, things that drive them, things that move them, and those flows can be seen intraday. We're going to start looking shortly at some specific examples so you can see exactly what I'm saying. Now, the next area to look at is some of the different reasons. We've touched on this already, but you can get seasonal patterns in markets due to weather patterns, times of more rain or less rain, harvest periods. When are commodities harvested? Sugar, soybean, wheat, corn. All of these commodities have specific times when they're harvested. And of course, as a general rule, when a commodity is harvested, the price tends to be at its lowest because there's an abundance of supply. And just before the harvest, when the commodity is at its lowest ebb, that tends to be when the prices are higher, because there may be demand, but there isn't as much supply, and demand is outstripping supply. Also, interest payment timings. This can be very interesting. If you have certain payments that take place consistently across different periods of the month. Investor sentiment at certain times of the year. It's quite fascinating. You will often see certain markets rising at certain times of the year just because people are feeling more optimistic. There's the so-called Santa rally in the US stock markets, and it is a statistical, reliable trade, is that people just tend to feel a little bit more optimistic. It's around Christmas time. People are used to buying gifts for friends and family in the West, and that kind of giving, buying mentality flows through into the stock markets as well. You also have things like regular fund flows and tax payments. For instance, there was a trade that I took at the end of this year, which I'll run through with you, when there was heavy dollar selling was expected in the market because the US was expected to have a slower recovery than the rest of the world. The Federal Reserve is expected to keep interest rates low, quantitative easing's high, and crucially, there is a taxation incentive to send US dollars out of the US into daughter companies around the world for taxation reasons. And that tends to result in US dollar outflows in the last sort of 7 to 10 days of the year. Knowing those little bits of information can be crucial in getting some very, very significant trades. So I will go through some trades that I've taken, and I'll also go through some trades, a trade that I'm in at the moment, and how I go about using seasonal patterns to make sense of this. So the obvious question is this: well, how reliable are they? Is it just a statistical anomaly, or can you rely on these seasonal patterns? Well, let me show you some seasonal patterns that are in some of the most common instruments that are traded around the world. Let's look at some of the major indices, and we're going to look at the Dow Jones, for instance. Okay. Now, there's all sorts of sayings that you get in the financial markets. And one of the Wall Street sayings is this: sell in May and go away. In other words, for the trader, the little saying that gets banded around traders and around those who are interested in trading is this: sell in May and go away. In other words, equity markets don't tend to rise in the summer. So the thought is, we'll just sell them and forget about them. Move your cash into some other market, but just don't let them sit in equity markets because you tend to see flat trading with not much going on. So that let's take a look at that rule. Now, if you look here, you can see on the chart, the red line is the return in the Dow Jones between May and October over the last 50, 60 years. And if you look at that return, you can see that the return between May and October has been extremely flat. There's not been strong gains. But if you look at the return from November to April, you see that there's a over 3,000% return by buying the Dow Jones between November and April and not owning it at all between May and October. Now, straight away, you can see that there is very, very clearly a statistical seasonal pattern. Now, if you're a good analyst, and if you're assessing data, you might say, well, what is the evidence that that seasonal pattern has a fundamental reason for it? It could just be a statistical anomaly. It could just be a freak of nature and a bizarre random event. How do I know that's reliable? Well, there is a reason why this pattern is in play. And the reason is this, is that during this period from November through to April, that's when you tend to see inflows into mutual funds. You can see that during that period, the flows are very, very high. You can see November, $4 billion. December drops to just under $3 billion. But then look at January, $12 billion of inflows. Just under 10 in February, March and April. So the first 4 months of the year see a huge rise in mutual fund inflows. And of course, those inflows are going into the major indices across the world, and they're lifting them. So in this way, you can see, look, even for the casual investor, that buying your major indices at 1st of November, holding them through to the end of April, gives you far superior returns than even holding it all year round. So that a little fact for the Dow Jones shows you how to get more serious returns. And it's a tremendously beneficial piece of information to have. Now, the thing to be aware of is that seasonal patterns are generally reliable, but they don't follow every single year. Okay, you have to be aware of that. They're generally reliable, but don't follow every single year. So the so-called Santa rally or the Christmas rally is a very reliable pattern. And you can see, look, that in this chart here, that between December the 14th and January the 4th, that over the last 71 years, the S&P 500 has risen 53 times. So statistically, it is very reliable. But you see, it's not always the case. And in some years, you can see that the S&P 500 actually dropped during that period. So that's a very, very key aspect to be looking at. And so, for example, in the last Christmas period we had, it was very reliable that we were expecting equity markets to rise, because equity markets were expected to rise anyway. You had a large US stimulus package that was coming. You had interest rates being kept exceptionally low. We had the new strength from a Pfizer and BioNTech vaccine around November. So at the time, during this last Christmas period, the canny and the wise trader would have known there are important fundamental reasons for the equity markets to keep rising, and there's important technical seasonal patterns. And when you combine those two elements together, you can see that you're putting the probabilities of trading in your favor, because the probabilities of it being one of the years when the S&P 500 drops is very unlikely, because not only is the seasonal pattern, but there's important fundamental reasons for the prices to keep rising anyway. Important point to note. So here's the S&P 500, 71 years. You can see that if you kept that every year from the 14th of December to the 30th of December in the S&P 500, you would have made an annualized return of 35%. Fantastic. What, for holding it's for having exposure in the market for 2 weeks? It's fantastic. And the average return 1.34%, and the maximum loss 4.3%, maximum profit 7.98%. So pretty solid, pretty reliable, and a pretty decent trade to be looking for. Okay, so I've one moment, please. So I've been looking at American stocks. What about European stocks? What about the FTSE 100? Okay, so FTSE 100. If you look at the FTSE 100, you can see here that if you hold the market from May to October, you can see the red line. You can see that the returns in the FTSE 100 are inferior. when you compare, that's the red line. When you compare that to the green line, notice how you actually get better returns than the FTSE 100 itself. So you're better off since 1984. So hold the FTSE 100 between November and April, and then let your money go. Now, as an investor, that is such an important point of information, because it means that instead of just buying the FTSE and holding it, it means what you can do between May and October. You have May, June, July, August, September, October. You have 6 months where you can allocate your finances to some other investment. You could do all sorts of different investments that you can use that money for, knowing that actually you're more likely to have superior returns in the FTSE 100 from a historical perspective. Again, because of those fund inflows. Now, if you take a look here at the seasonal returns elsewhere, I've looked at some of the major indexes here. And if you look at Canada over the last 50 years, you can see that the winter period, that November to April period, has a return of 5.68%. You can see the top of the chart. Now, the total return is only 5.45%. So again, you are better off holding that equity market between November and April at 5.68%. Now, if you held through the summer, you could expect a seasonal return of minus 0.22%. So you see, you are disincentivized from holding over the summer. Look at China, and you see some really outstanding results. Now, remember, China is the world's second largest economy behind the US. And China has obviously a very strong manufacturing base, and manufactures very cheaply for the entire world. And the growth in China has been a key driver behind the global economy. Now, China has such an outstanding rise in November to April, over 12%. So that's been fantastic, November to April, but only 0.06% in the summer. France, again, look, 6.74% in the winter, but it has a fall of minus 3.24% in the summertime. So again, you see superior returns in the French index, the CAC 40, over in winter compared to the total return of the CAC 40. Fantastic. Similarly, you have the German DAX. Now, the German DAX, again, 6.92% versus a return of 5.73% over the course of the whole year. One difference to note is if you look at the Indian Nifty, you can see that it has a more equal return, 5.79% over the summer and 6.25% in the winter. And it seems to be rising more evenly over the course of the year. So the India's Nifty is a good exception to the general rule. Now, looking at those figures, you can see that the benefits of investing in that winter period, November to April, and the general idea is, the general sort of word on the street is, you sell the end of October. A lot of my analysis says that if you just do a little bit before the end of October, you buy at the end of October equity markets. Some of my analysis, just a little bit before, so buying around the 20th of October is a good time to get into that rally from November through to April. At this point, I'm just going to pause and give students an opportunity to ask some questions about the seasonal inflows that we see in mutual funds and how that expresses itself in seasonal gains in the world's major indices. Please do take a screenshot of that table. It'll be very helpful, and you can use it for your own research, and you can just take it away for yourself in your own life, seeing that strong seasonal pattern that is in the world's major indices. Okay. I'll give folks 30 more seconds, and then I'm going to carry on. Okay, I'm assuming everything is clear. If you do want to ask a question, please do ask it. I'm going to carry on with the presentation. Okay, so one thing to note here that's very interesting is this movement in the dollar index. You can see here, this is a seasonalized chart with the 100 being the base level, and the rise in the blue line shows a seasonal strength, and a fall in the blue line shows a seasonal weakness. And what you can see that over the last 25 years, what we tend to see is, you notice the dollar index tends to fall sharply into the end of the year. Can you notice that? You can see as large US companies move money to daughter companies to save taxes. See that short drop in the dollar index. Now, similarly, look at the rise in January. As money comes back into the US, what do you see? You tend to see a strong rise in the dollar at the start of the year. So you can see straight away that over the last 25 years, look at the general return for the dollar index. Can you see how it's predominantly selling? In the last 25 years, 20 years between the 21st of December and the 1st of January, you can see the dates in the top right hand of the screen in the slightly blue turquoise box, 21st of December through to 1st of January, you can see selling in the dollar index. The largest fall was minus 2.46%. That was in the year 2000. And you can see in the year 2020, we saw dollar index selling into year end. Now, I'm going to show you how I use this in my trading. So you can see how this can equate to real world action. Now, the chart I'm going to show you here, this is a chart of the dollar index, and it is the weekly chart. Now, around the end of the November period, December period, you can see on the chart, you can see a red line, a red arrow, and a blue line, and a red arrow opposite the blue line. So the red arrow is where I entered, and the blue line and the other red arrow just connected to the dotted line is where I exited the market. So you can see here, I was selling the dollar index, and I made a profit as price moved down over the weeks going into the end of the year. Now, let me explain the rationale. At the end of last year, analysts around the world were nearly universally bearish or negative on the US dollar. The US was expected to recover much more quickly than the rest of the world. The spread of COVID-19 had been quite virulent in the US, particularly under ex-President Donald Trump, who took a very hands-off approach to the virus in many ways, and it became politicized in the US. Whether you wore a mask or didn't wear a mask would reflect your political background. So that politicization of basic hygiene meant there was a disincentive for a certain segment of the population to adhere to COVID-19 preventative measures. So COVID-19 was rising strongly. We also had the fact that the Federal Reserve has had very low interest rates and was reassuring the markets interest rates will be kept low until 2023. More reasons to sell the US dollar. The rest of the world is expected to recover more quickly. Further pressure on the US dollar. So that meant that I had a fundamental reason to sell the US dollar, and I had a seasonal pattern to sell the US dollar, because I knew that seasonal pattern was based on taxation reasons for US tax companies. They would be selling US dollars as they exited them from parent companies and put them to daughter companies around the world, so that from a taxational perspective, they would be more tax efficient. Putting that together meant that using some technical skills, which would be a great topic for me to return and share with the students here at Murdoch. But I can't go into some of the technical patterns that are here, but there was also a solid technical pattern using charting abilities and charting analysis. And so everything was coming together to sell the dollar, and that was a very smart trade. Now, at the start of the year, do you remember what we saw? We saw that at the start of the year, the dollar index tends to rise. You can see the left-hand side, money comes back into the US. And so I was not going to be holding the position into the end of the year, because I knew that the dollar tends to rise as money comes back into the US. And if I just show you the dollar index chart, I'm just going to exit this webinar for a moment, and I'll just show you the dollar index, and I'll show you what happens, because it will really be helpful for you to see this playing out in real time. This is the same chart that I showed you, the dollar index, and you can see here the start of 2021. You can see as price fell into this key support level on the left, we saw dollar buying the start of the year. That's that dollar buying the first couple of weeks of the year, which is what we'd be expecting on that seasonal pattern as money comes back into the US. So there you can see a clear example of how the seasonal patterns impact on the financial markets, and how, as a professional trader, I go about using that information in a practical way. Now, another strong seasonal pattern that you tend to get in action is this, that you tend to see gold prices tend to rise from the end of December to the middle of February. Now, there's important reasons for this. And the important reason is that there's a celebration in China, the Chinese Lunar New Year, and that celebration often involves the giving of gifts. Now, giving the gift of gold, particularly in the Far East and the East, has more significance than it does here in the West. So I've got a gold ring on my hand here, and this gold is relatively a cheap gold. I got 9 karat gold because that's harder wearing, and I know what I'm like, bashing around and moving around and doing things. I knew that if I got a purer gold than the 9 karat, my ring would be bent and broken very easily. And I have been married 20 years, so it still lasted, and it is still the shape that it was originally when I was given. So I'm pleased with my decision. But gold in the East tends to be of a much higher quality, higher purity, because it's a store of value. And when you give a gold of gift, you're giving an investment. It's a different social function necessarily than in the West of giving a gold gift. Has less significance because our currencies in the West tend to be firmer, so it's safer to have your investment into a currency, whereas the further east you go, it tends to be generally safer to have your some of your investment at least partially in gold as a store of value. Now, so that tradition of giving gifts means that there is an inflow into gold around the end of December, coming into January, middle of February. You can see here on the charts, look, in the last 9 years, in the last 10 years, gold has risen 9 times out of the last 10 years when I took this. Now, I have to check what happened in 2020. But I'll show you how I use this in my trading. So you can see here that I bought, on the left-hand side, you can see I bought 2 gold positions around 1858, the 2 blue arrows, and I sold them up at 1922. Can you see the dates? I entered 15th of December and I closed 31st of December. Go back here and you can see, look, there is a strong rise in gold around that time. So I know in my mind that gold has bids around this time in expectations. Now, there's a couple of things that bothered me this year. The first thing that bothered me is because of COVID-19, would people be celebrating the Chinese Lunar New Year? Now, there had been a popular celebration around October in China, and there had been general movement of people. So I took confidence that there had been a popular festival. It had been attended. There wasn't a huge spike in COVID-19, so it told me that the infrastructure of China could manage it. So at this stage, remember this is December, so this is about a couple of months before the Chinese Lunar New Year. Usually you have to think ahead. I'm thinking, okay, at this stage, I don't think this is going to put investors off. And if you notice where I entered around that 16th of December, those of you who are very observant will know that that was the last Federal Reserve interest rate meeting. Now, one of the key drivers for gold is the US dollar. And obviously the key driver of the US dollar is the Federal Reserve monetary policy. So I was waiting to enter gold because I wanted to make sure that the Federal Reserve wasn't going to surprise me. If they said they were more optimistic, if they saw interest rate hikes coming, if they were, a little bit more optimistic than the market was expecting, you'd expect the US dollar to strengthen and that would weaken gold, which is incidentally is why gold's weakening now. I could do a whole webinar itself on gold prices and the US dollar and the US 10-year yields and what's happening right now, but I won't. But what I wanted to show you is how I use this information, because there on the 16th of December, the Federal Reserve came out and the Federal Reserve was going to maintain a dovish outlook, 3 years, no interest rate rises, high quantitative easing purchases, negative on the US economy, promising support, and I knew that's going to be weakness for the US dollar. So that gave me the confidence that I had monetary policy in line with US dollar weakness, which would be supportive of the inflation busting gold, which would be in line with the seasonals. So all three of those lining up. And then I took profit a little bit too early, 1922, but for me, that's it. I'd made the trade. I'd made some good profit on that position, and I wanted to be closed out before the Christmas holidays so I can relax with my family rather than worrying about a gold position that I've got on in the markets. Close it out, make your profit. And I left one position at break even. You can see that position there. That's the green dotted line and the red dotted line. I just left that at break even in case prices kept rising higher. I was well positioned to benefit from that. In the end, they didn't. I was knocked out around break even. So it was a good balance between taking the opportunity that was presented and leaving the opportunity for superior returns should market conditions be in my favor. Another great trade that I wanted to show you was platinum prices. This was a really good market. Now, I executed this quite poorly, which was a shame because this was a fantastic trade with everything lining up. My execution was inferior. Now, what happened here with platinum is there was some very strong supply and demand issues regarding platinum. Demand is expected to outstrip supply for platinum for the next 2 years. Platinum is heavily in demand. Partly there's some green technology which is driving platinum. Nickel is expected to rise over the next 3 to 5 years due to its heavy reliance on the electric vehicle technology. So nickel is a commodity I'm very interested in at the moment. But platinum, you can see here, look, over the last 33 years, it's risen 25 times. Now, there are reasons for this. Platinum tends to be bought at the start of the year. It's an industrial metal, and purchasers tend to buy it around the start of the year. It's just for purely mainly industrial reasons. Now, purchases managers, when they're making their business plans for the year, tend to make all those purchases at the start of the year. They either don't know or don't care. Remember, not everyone who's investing in commodity or FX markets are buying commodities or FX or buying currencies to speculate or to invest. Often they're just movements within companies. And this is an example with platinum. The purchases are made at the start of the year. We see this strength in platinum. Now, you can see here the superior gains. Maximum profit 14.81% came in 2011. Average return 3.92%. Here was one of the trades that I took in platinum and really did not do very well with this. You can see I entered around 11th of December. I held through to the start of January, and I should have held much longer, but I just ended up taking my profit. Now, what happened is I ended up taking a second position I was in a trading competition, and I ended up taking a second position for a technical reason, and I ended up losing because I was buying up near the highs and I didn't want to see price move lower, and then that affected my psychology for the position in my account, and in the end I just closed out, so I was roughly flat between my two accounts. So that was the reasons for the execution. Trading psychology is a whole different topic, and worth a lot of time. But you can see here that everything was aligning correctly for platinum. It's funny. I spoke to a fund manager. He was just approaching retirement. I said, "Oh, have you seen platinum prices?" And he said, "No, platinum's not going to rise." And I did a couple of some researchers pieces for him, and he invested, and he did fantastic for his hedge fund. And then I'm the one who told him, and I'm the one that didn't particularly benefit from it. So that was a frustrating trade for me. Sometimes you get superior returns in individual stocks. Now, here's a good one for Netflix. Look at this. This is Netflix. Now, I made just around 10% return on Netflix this year on this fact. Now, Netflix tends to gain on earnings, but it's got a habit of exceeding its earnings expectations. It tends to do it year after year. You can see last 18 years, it's only lost once. Between when? 18th of January, the 1st of February. So that first initial earnings seasons of the year, Netflix tends to gain. So for me, that's definitely worth investing. Now, as you remember, when I was taking the webinar here with Murdoch about the investing during COVID-19, I was explaining that some stocks that tended to rise high were the so-called stay-at-home stocks. Facebook, Netflix, Amazon, Google. NASDAQ really rocketed through COVID-19 due to the fact that people were at home, spending online, and that was boosting these companies' profits and bottom lines. So my analysis was, well, hang on, Netflix has been used by so many more people this year. We're coming into the earnings seasons. It tends to, exceed earnings expectations with an average return of 13.50% each year. My expectation was that it would do exactly the same. Now, I literally just bought in around this very low period. If I was to do this differently, I would have bought in around the end of December in anticipation of this event. It would have been a much smarter trade. But nonetheless, bought in, the earnings expectations were a strong beat with a strong forecast for the future, and all of that supported Netflix gains. And again, a great little trade for just 2 weeks of exposure into the market. Now, how do you integrate seasonals in your trading? Well, here's like an example. So you can see here, you can see 7th of March to the 15th of March. You can see that oil tends to have a weak time of the year. You can see you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You've got about 12 losses and 7 gains in the last 21 years. Now, going into the crude market, I just knew, so this is a better, you just knew that actually there's a significant event coming up this week. And so I knew, look, hang on, seasonals are very poor for this time of the year. You tend to see falls in US oil. Now, I knew OPEC are due to meet this week. So I thought, hang on, there's a couple of things here. First of all, oil, there's reasons for oil prices to rise, okay? You can see this is a oil price chart. And this is a trade I actually took. See that red line? That, from a technical perspective, is called resistance. Now, that resistance level is very strong. Do you see how it's respected in just around spring of 2019 and around spring of 2020? It's respected, rejected, respected, rejected. Now it's tested at the end of last week. Now, with equity markets selling off, I knew that that would result in commodities markets selling off. I knew that OPEC is meeting this week. Now, OPEC are rumored to possibly increase supply to the oil markets. Remember, January, Saudi Arabia surprised markets and said, here's a 1 million barrel per day production cut as a surprise, just to help the oil prices rise, help OPEC. Saudi just showing its leadership within OPEC, taking responsibility. And you have to say, look how well they've done in supporting the oil market. Been a very effective strategy. So the question now is, what will they do next? Will they increase production? Now, Saudi will be very conservative, and they will err on the side of, well, you know, hey, look, this is working. They're playing the long game. Let's keep production low because, wow, look, it's helping oil prices. This is going to be good for us in the long run. Let's keep it going. Russia will be more like, well, you know, oil prices are high, so let's benefit now from them. So you can see there's a tension, that politics come into play. It's fascinating. So with price moving into this overhead resistance level, I just knew, well, why is price going to keep going past 64, 65? Because the market's uncertain. The market's going to wait to see what OPEC does. And if OPEC adds supply, you might see some heavy selling. So I sold off oil markets into Friday just as we were around that sort of 63.38 level, just underneath that 64 level. Sold the markets, again, using the geopolitics of OPEC, using the intermarket analysis with falling equity markets, using the fact that there was some strong seasonals for oil, tends to be a weak time of the year. So putting that all together, that's how I'm informing my analysis and my trading decisions to help me become a profitable trader for this coming year. So that's what I'm doing. This was just a, I'll send this to you. So I'll show you my blog and I'll just show you how I was, you can see some of my analysis here in Platinum towards the end of last year. You can search my blog and it just shows you all the information that you need. And it goes about outlining that position on Platinum. I thought it'd be helpful for you to see, just to see how an analyst goes about putting things together. So I've sent that to you. And that was the Platinum gains. And that was, so that was just showing you, that was the seasonal pattern. So you can see here from the 12th of December to the 18th of Feb. So you can see here. So if you just followed the seasonals, you would have done a lot better than I did. You see that strong rise. So if you bought on the red line, sold on the red line, you would have made a very decent profit in that market. Another thing to say is Tuesday tends to be a very strong day of the week for the S&P 500. There is a phenomenon called turnaround Tuesday. And can you see that if you just bought and sold the S&P 500 on a Tuesday, you'd be better off than holding the S&P 500 index all week? Isn't that fantastic? That one day. And there's a saying, markets don't bottom on a Friday. So in other words, if you see a low on a Friday, it tends to be a low, even lower on the Monday. That's a pattern. I see it time and time again in all my years trading. And this is the statistics for it, that what you see is a low on a Friday, markets hardly ever bottom. Think of the psychology, it makes sense. Because if you're worried and fearful and you're selling, Do you suddenly start buying before the weekend? No way. Because you think, well, it could get worse over the weekend. If there's a factor that's driving the selling, you think, oh gosh, the last thing I want to do is, buy on a Friday. So you can see Fridays is the weakest day of the week for the S&P 500. Monday, and then Tuesday, turnaround Tuesday. Markets digest, maybe think, well, we're oversold. Oh, it's not that bad. Hang on, we've got 3-4 days. There's some optimism that something's going to be sorted. So Tuesday tends to be a good day of the week. And I was buying the S&P 500 last Tuesday using this data as Fed Powell was speaking before Congress. I thought, hey, look, it's turnaround Tuesday. And I'm expecting Fed's Powell to be more dovish. He was. And great, made a profit. Statistics, turnaround Tuesday. Now, some words of caution. Okay, seasonality is based on historical data, but not every year is the same. Remember, there's fundamental psychological, political factors that influence the course of individual years. And also extreme movements can have more of an influence. So if you get one outstanding year, it can lift all the years. But, what I'm looking for, the seasonal pattern, I'm looking for some kind of generally good data the whole way. I don't want to just trade something with one incredible year. It could be a reason that you have no control over. So just have to be aware of that before you go away and think, right, seasonal trading, I'll just only trade seasonals. There are fundamental factors, and the way I use it to support my analysis, not to replace my analysis. And for me, I feel more comfortable like that because I feel that I'm in control and I am making decisions that are rationally based. Again, best time of the month to invest is from the 26th of the month to the 5th of the month in the major indices. If you look here, this is the cumulative return of the S&P 500 around the turn of the month and the rest of the time red from 1970 to 2018. So in other words, if you just invest in the US stocks, S&P 500 from the 26th to the 5th, look how much better the blue line you are than the red line. It's far superior returns. Again, look at the FTSE 100. If you just invested from the 26th of the month to the 5th of the month in the FTSE 100, you would be far better than the rest of the month. The DAX, exactly the same. Why is this? Well, it's very simply because at the turn of the month, monthly cash flows, salary payments, when do you make your payments? When do you make your standing orders? Oh, I've just got paid at the end of this month. So I'm going to move my £500, my £1,000, my £100, whatever it is that I put aside for investments. I'm going to send it to either my fund manager or I'm going to buy into the index myself. And those inflows into the major indices and stocks around the turn of the month give you those superior returns. Well, I have given you a whistle-stop tour of the things that I'm covering from a day-to-day basis, and I hope you found this session helpful. It's certainly a key function that I use in my trading day-to-day. And if you want to keep up to date with me, there's a number of different ways. You can follow me on Twitter at Giles Coghlan CCA. That's my Twitter handle. You can follow me at LinkedIn, and you can also email me directly at giles.coghlan@hycm.com. You can take a screenshot of all this information if you want to follow my analysis. And I also have my HYCM blog. Now, all of my information goes onto my HYCM blog, and including daily, often seasonal highlights, which I try to analyze and give to HYCM clients. And I also have some great programs that I've personally set up to help traders take their trading to the next level, as well as some free training program for HYCM clients. So if you were interested, please do contact me, and I'm happy to help any way that I can. I love teaching traders, and I've taught hundreds and hundreds of traders over the years. It's something that I really enjoy doing. So it has been lovely being here. And don't forget, every Monday around this time, 12:30 p.m. to 1 p.m. GMT time, I do a live market analysis, helping people to know what the key market events are coming up for the coming week. Well, that leaves us 5 minutes for some questions and answers. If you'd like to ask any questions at all, please do type them in the Q&A box now, or the chat box. I've got both of them open in front of me. Okay, question from Daphne. I want to experience investing in real money to understand the trends in finance better. What type of research should we conduct as a beginner in the finance world and investments? Can we invest, trade in small amounts? And what advice would you give to us? Daphne, yes. Okay. The first thing that you need to do if you are looking at learning to trade is you need to have someone who can coach you. Trading and investing is very difficult. And there are certain things you can do that make it impossible for you to trade. So the first thing that you need to learn is you can also demo trade. So the first thing you want to do when you're learning to trade, you want to do what's called demo trading. You want to do it as a pretend, and many brokers offer you demo trading. And then always trade in a small amount. Now, the way you do this is you always allow your position size to match your trade size. So for example, say you had $1,000 that you put into a trading account. Only trade a trade size that matches your account size. So if you're trading with $1,000, trade 0.01 of a standard lot. Brokers, as a general rule, will want you to trade with more because they make more money. If you trade with large amounts when you're first learning to trade, you will almost certainly lose all your money. There is a rule, there's a 90-90-90 rule that 90% of new investors will lose 90% of their money in 90 days. So the first thing you have to do is, until you understand exactly what you're doing, don't invest any real money. When you do invest real money, don't use leverage. Use non-leveraged trade. Use a cash account. So if you're investing, if you can, invest only in cash and don't use leverage. That will help you a huge amount, Daphne, because if you do make mistakes, you will be limited in your losses and you'll be able to recover from them. The danger is if you use leverage, you'll make mistakes and you might never recover from them. And then you might never invest and trade, and which will be a shame, because with a little bit of experience, as you can show, as I've shown you, just that little bit of knowledge about the FTSE, the S&P 500, and when to invest, when not to invest, can give you superior returns in the market. And that's for doing one trade a year, you know. So it's important to get that. As I said, I can be contacted for specific programs. I have put programs together, you know, that help people, and you can always contact me for more details. But I hope that's been a general bit of advice that I would give you. Nikita says, this has been a very informative session. Thank you. Could you share some guidelines in terms of starting as a young trader? Also, would you think blockchain would be a game changer in trading? Yeah, Nikita. The number one thing is to get someone who can coach you. Okay. Trading is hard. If you think about it, it's as hard as doing a degree. Okay. Really, if not harder. You have to have tutors, you have to have a coach, someone who can guide you in the first direction. The first thing that I would say is, like, look at central bank policy. So I'll just show you something. Just going to move my thing. If you look here on my blog, right? If you look here on my blog, there is a section called Market Fundamentals, and there's a section called Central Bank Watch. Okay. Now you guys will know, because you're finance students, you've already got a big heads up, because you understand that, look, currencies are driven by central bank policy, right? You understand that. I assume, of course you do. Central bank policy drives currency moves. So here with the central bank watch, understand what the currencies are going to be doing. Okay. So here, these are all my articles. So, you know, I'm looking at what's the Reserve Bank of New Zealand going to do tomorrow. So I go through it. I go through some of the recent economic data. I go through market expectations. I go through what I think is going to happen and why. And all of that is just something anyone can do once you have been trained and once you know what to look for. And then there was the decision, and I go through the decision. It was exactly as I expected and exactly what I thought would be continuing New Zealand dollar upside. And that's exactly what happened. We saw strength in the New Zealand dollar Japanese yen pair because of the RBNZ statement. So Nikita, you need to get a coach. The first thing is look at central bank policy. And when you understand central bank policy, you start to understand how that moves the currency markets. What's the Federal Reserve going to do? What's the ECB going to do? What's the Bank of England going to do? Their moves dictate currency moves. There's obviously other aspects that flow into this, but that's the best place to start understanding a central bank monetary policy. Also, would you think blockchain would be a game changer in trading? Not at this stage, because trading has a number of different instruments. Not all of them use blockchain, and some of those instruments have long, deep-rooted, not only data reasons for remaining as they are, but practical, fundamental reasons. You know, whether you're trading bond rates, whether you're trading commodities, whether the future markets, whether you're trading individual stocks. I don't see blockchain being a game changer in trading at this stage. I think it is significant in other ways, but in trading, we'll still have lots of instruments to be trading, and cryptocurrencies is just another one of those instruments. It's just another instrument for trading. And if you see here in my analysis with my blog, you'll see that I was talking about Bitcoin going up to $100,000. Let me just show you where that was. Right, and you can see here, I was talking about Bitcoin, and I'm just going through a market report on Bitcoin heading up to $100,000. But when I wrote this report, this is on the 12th of October last year, and you can see Bitcoin was around $12,000. So I was writing this report, showing people technically how to enter it, how to trade it, how to manage that risk. And you can see prices shot up sort of $50,000, $60,000. You know, check out my blog. There's some real gems there. Yeah, Nikita, that's right. Trading requires patience, yes, knowledge, but one thing that it's knowledge. It is basically knowledge, Nikita. And if you are informed with the knowledge, you can learn to trade. Many people make the mistake. They try to trade thinking they don't need the knowledge. It's ridiculous. It's like trying to be a doctor without studying medical school. Now, it doesn't matter how you learn. You just got to learn it. It's like trying to be a lawyer, but you've never been to law school. Can you do it? Well, maybe, you know, if you just keep at it and you go find some other route, but it's not a convenient way to go. So you need to find some kind of keen analysis, read good analysts, get some good coaching, get some good advice, and then keep at it day by day. And over time, your skills develop and grow. Abubakar, what are good factors to analyze if a company is likely to do well apart from seasonal trends? It's things like, you know, price to earnings ratio. What are the expected earnings? Where's it sitting in relation to the rest of the index? What sector is it within? Is that sector expected to grow or to shrink? There's many different factors for looking at an individual company. My focus is mainly on FX, commodity, and indices. That's my focus. I don't focus on individual companies. So I wouldn't be able to help you with any more than that, Abubakar, apart from that very general answer that I've been able to give. Well, that's great. I think I've got through the answers to the questions you've asked. Thank you all for your questions. Excellent questions. I'll just leave up the information on my on the screen there, so you can just see if there's any information. Want to get in touch with me, want to follow me, you can keep up to date with what I'm doing, and I would love to come back again sometime. And if there's any topic you'd like, please do speak to your supervisors, and I'll be very happy to help with any topic that I can.
All right. Thank you so much, Giles, for the wonderful session once again. And I believe everyone really learned a lot today. Thank you, everyone, for participating. Bye-bye. Hi, Giles. Thank you so much.
Oh, you're very welcome. It was lovely to be with you again.
Yes, lovely to have you again. And yeah, it was a very, very nice, intense, interesting session. Learned a lot. And I'm pretty sure we'll be requesting you to come back soon. So really look forward.
It would be lovely. What sort of topics do you think the students would like? Because if I ever came back again, it would be good to have a bit of a direction.
Yes, I'm actually planning to talk to our head of finance next week together a little bit more about, what are the topics of interest. In fact, we are thinking of sending out a survey as well to students with a couple of
Yes.
this on what is, what else they would like to know. Because of course, most of our students are extremely in the beginner stage. So
Do you know, a good topic would be something like how central bank policy influences the currency markets.
yes. Yes.
That would be good. Another good one that I would be concerned about is sharing this information. I would also like to share with students how to manage their risk.
Right.
Because I don't want to give people enough information to be excited, but then they end up doing a silly mistake.
Absolutely.
So I would like to maybe if I did come back, maybe do something with managing risk as